Good morning.
Good morning.
How have you been, Sal?
I'm very good, and you?
I you're not modest though.
I'm very well then. Okay, I'm very well.
You're very good as well. I give that to you.
How you doing, man? You good?
I'm good. I'm good. Um, Everything is fine. TGIF, right?
Yes, sir. It's been a long
And
week.
yes, and we're having NFPs today, so hopefully it's going to prove to be an interesting day, right?
Yes.
Now we haven't had too much data coming out since yesterday, at least nothing really groundbreaking, market moving, etc. We've had house price index index from the UK that missed. We had the industrial production from
Having
Germany.
said that, though, we have to note that house price index is still in double-digit territory.
Yeah, of course,
It went down for I used to live in the UK, for years and years. So I
and
look at the
you own
housing
the
market.
house. You own the
Yeah,
house
yeah,
there
yeah,
as
yeah.
well.
So I've known the housing market quite well there. I've owned, I've rented, I've lived there for a few years, and there were a few years like 17, 18, 19, 2020 as well. We were running in the low single figures, like 2, 3, 4% year on year. Now we've gone back up again above 10, and it just shows inflation. In the short term, rising mortgages will rising mortgage rates are going to push demand for houses down. This is all, though this is a short term effect, and in the medium term, when you have double digit inflation in everything, real assets, they have to follow, right?
Of course.
And yes, Gavin, it's been stupid. The housing market in UK has been crazy for decades. I still remember when I was a student, my father bought a flat for me and my brother, very close. We went to Imperial College in South Ken, so he bought a very nice flat on Queensgate, which is a really nice street, and 2-bedroom flat, £109,000. So we were studying there for 4 years. This is 1989.
I assume today it must worth more than $1 million, right?
109. Today is 1.5 million plus. It's ridiculous. So it has been for decades and decades. And there's been, what's weird about the UK housing market is that there has been no downturn. There was one slight one in the early 90s where everything was, a little bit crashing a little bit. But really, there has been no sustained downturn in housing in the UK. And not only that, it's been a straight line. And, people say it's because taxation on housing is practically zero. So it's a really nice way for people to park their money. And you see a very good example of that is my brother still lives in the UK, and he owns a really nice flat in a development in Chelsea. And I think there's like 180 flats on that. By the way, Daniel Radcliffe, Harry Potter lives there. Anyway, over half of them are empty. And every time I go there, I can see they're empty. They've been bought by people and just park the money there, and then, forget about it. Because taxation is so low, or it's basically zero. You pay tax on the stamp duty to buy it, and that's it.
And when taxation is very low, it means that you can have the asset acting in essence as a hedge for inflation, right? Because as we said, anything with intrinsic value, in general, I'm not advocating for people to be buying houses, because on most places there is a rather decent to high taxation to owning a house. Although, on the other hand, owning land usually has a very, very low taxation. Plus, the cost of maintaining land is practically zero, right?
Yeah, it's a lot easier. Yeah. Anyway, just something to remember. Double-digit growth in housing prices in the UK. It's crazy. Yeah. Okay. So we had that. You're right. We had German
industrial production came in higher than expected, at positive 0.4, with expectations being that it would worsen from negative 0.1 to negative 0.3.
Yep. Italian industrial production was very, very weak. in contrast with the Germans.
No big
So
surprises.
but really we're all waiting for payrolls today, and as we've said so many times recently, data has become a lot more important.
Data matters. So the market really
Exactly.
is expecting of that data to move, right? Because if you notice, the vast majority of the markets once again yesterday didn't move, and because people don't want to commit ahead of the NFPs, right? So as simple as that. They're either holding to their positions, trimming their positions, but I don't think many people were, opening new positions yesterday ahead of the NFPs. Probably they're going to do so once the NFPs are out of the way. One of the few exceptions was crude oil, right? Because crude oil did keep moving to the downside, as we said, and it did slice through 91. So as we've said, it's on its way to 85. Right, so nothing has really changed here. 95, 96 is now resistance, and 85 remains the downside target. So crude continues to be on the move, but the rest of the market has, in essence, not done anything in a couple of days, right? USD yen remains. I keep focusing on this because it's technically really interesting. It got rejected from the 134.50 area we were talking about. Now it remains trapped in this range, right? 131.50, 134.50. Whichever breaks first, we're going to see a continuation in the same direction. We break through 131.50. In my opinion, we open potentially quite a lot of downside. We break through 134.50. 137 is the next upside target. And of course, USD yen is the pair that's also going to give more or less direction to the rest of the yen pairs. Now, cable, nothing has changed since yesterday. It's still riding the top of this descending channel. Probably today, it's the day we're going to find out if this is a breakout and we're continuing higher following the NFPs. I expect that most likely the dollar is going to move. So if the dollar's next leg is lower, cable is going to detach itself from this trend line resistance and keep moving to the upside. Speaking of the dollar, having a look at the dollar index, here we are. 105.30 remains support, right? In any case, in the short term, we've been creating lower highs, right? We got rejected on Wednesday, but yet we didn't manage to post a higher high. So for the time being, we remain in some kind of corrective pullback pattern here. Now, many people claim that this is the beginning of a new trend lower, but as I've said before, in order for me to make such a bold claim, at the very, very least, I want to see a breakthrough this ascending channels trend line support, right? Because it's very easy calling any little pullback, a big time reversal, but that's not how real markets work, right? So for the time being, this remains an orderly pullback until proven otherwise. And as I've said, the first big test, in my opinion, is going to be the ascending channels trend line support. So we are still some distance from that before dollar bears can start having victory laps. I'm also a dollar bear if we're talking about the long-term horizon. But as I've explained multiple times, I don't have, under current circumstances, I don't have a reason to be a dollar bear until we confirm some kind of a pivot. And to be frank, it's not only a pivot that's needed from the Fed for something like that to happen. There are more things that have to happen, right? Other central banks must remain more vigilant in their fight. I mean, we have to see some kind of a Fed pivot, but at the same time, other central banks are not pivoting. Now, how many people can expect the ECB to be that? Perhaps the BOE can be that now that the UK is more independent. Yes, I know they always had their own central bank, but having to do with politics, that matters as well. As I've explained before, unfortunately, central banks are the vehicles of politicians, right? So now, in general, I know that the BOE doesn't have is not famous for being a hawkish bank, but at least they might prove to be less dovish than others can be. Somebody can only hope, I assume. I guess we're going to find out. Definitely, we are sailing in uncharted territory in regards to the fact that we haven't been in an inflationary environment like this since literally the 70s, right? And the very, 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 very beginning of the 80s, because practically in the very beginning of the 80s is when inflation was squashed by really bold monetary policy tactics, right? Everybody knows that Volcker had to raise rates twice to 20%, right, in order to actually tame inflation once. I'm not going to say once and for good, because unfortunately 40 years later, by repeating the same stupid mistakes, we're back, at the same point that we were in the 70s. But and to be frank, it's exactly the same point, right? Many people, if we want to make a historical, review of what happened, for example, in the US, the 60s were the so-called decade of guns and butter, right? It was the decade that the government spending went through the roof because Kennedy, Johnson, etc. They wanted to at the same time implement several social programs, etc. Fight a war in Vietnam, send people on the moon in a fight against Russia, USSR back then. As part of the Cold War, who has the the better technology, etc. So the 60s was a decade that really had exploding deficits, and the result actually came back to bite in the 70s, right? That was the main driver for inflation in the 70s, right? And then Reagan and Volcker, in essence, put the house, somewhat in order. And now, what did we see? We've had a couple of decades of completely reckless fiscal and monetary policy, and the cherry on top of the cake was, all the spending, and in essence, helicopter money, modern monetary theory, you can call it as you wish, that was created to fight the effects of the COVID, measures, etc. And, what a surprise.
We wait to see what the next excuse is going to be for the next round of...
We found ourselves with 10% inflation. And now, in essence, we have to see how... It's really funny, by the way, Stelios. I was reading a lot of comments yesterday. By the way, the BOE, which at least seems a more honest central bank, is predicting, keep that in mind, guys and girls, 5 quarters of recession, right?
Yeah.
5 quarters of recession. That is almost 1.5 years of recession. That's a prediction of the BOE. I'm not saying that, although I agree, right?
I don't remember a central bank making such a prediction ever.
Yeah. So they're in essence predicting 5 quarters of a recession. On the other hand, who was it that came out from the Fed? Sorry. No, my mistake. Everybody from the Fed, of course, has come out to explain how this is. You remember, Stelios, the not QE. Now we have a not recession.
Yes.
And so it's really funny. We just rename everything, and problems go out of the window, right? If you name a recession not a recession, it's not a recession. If you name at the beginning when they went back to QE and they cut rates, you remember they called it a mid-course correction. You remember that?
Yes.
We immediately said, okay, we're going back to zero and quantitative easing. And they actually started quantitative easing, but they were trying to explain how the balance sheet is expanding, but that's not quantitative easing. And of course, just a few months later, they had to openly admit this is quantitative easing and actually give, monthly buying targets and all that. So, I mean,
Yeah.
it's a joke, right? We're living in a clown show somehow. Yeah. BOE lost its credibility. Yeah, listen, no central bank has real credibility because they all just take directions and act upon them, right? But we can at least admit to the following, right? There is no upside for a central bank predicting a recession, right? So I kind of agree with them. I think that one way or another we're in big trouble because there are two ways to move forward from where we are. Way number one, what the BOE currently claims it's going to do, because the BOE claims that it's going to keep raising rates and doing quantitative tightening despite predicting several quarters of recession more to come, right? So in essence, they claim that they're going to stay the course. Yes, they're not aggressive at all, but at least they're going to stay the course with their main target being inflation, right? At least for the time being, that's exactly what they claim. Now, on the other hand, there is the other alternative to see a pivot with inflation being really high. In my opinion, that might have a short-term effect in risk assets, in bonds, so on and so forth. But in my opinion, and we'll be here to reassess my long-term judgment once again for those of you that stay with us and or have stayed with us for years and intend to stay for more years. In my opinion, if we see such a pivot with inflation remaining sticky and very, very high, in my opinion, it's going to be a short-term pivot. By short-term, I don't mean like a few weeks. It might last for a few months. But once inflation starts picking up again, because as I said, I expect some kind of a pullback in inflation, right? So central banks might use that as an excuse like, oh, there it is. We've already tamed inflation. Don't worry. Yes, it's still very high, but it's already started its path lower, and it's a matter of time before it keeps receding until it reaches, let's say, 2%. That's what they might claim, right? But in my opinion, they do a pivot to try to save face, to try to save the nominal GDP growth, right? Because that's all they can save, and risk assets. We're going to find ourselves with a lot more inflation than we currently have. And the next time they have to fight inflation, there's going to be no ability to do a pivot because it's going to already be obvious that if they pivot again, you see a high at 9%, let's say, inflation, and then it pulls back a little bit and you do a pivot, and then you have another spike of inflation that this time it's going to go easily to high teens or mid-teens, right? 14, 15% inflation. And then what do? You do the same pivot again once you start hiking rates and you go to another recession. So next time you have inflation at 20%. I mean, there is a very limited tolerance in societies about this kind of a situation. So sooner rather than later, somebody will have to actually fight inflation, right? Not for any other reason, but because, in my opinion, the political side effects and societal side effects at some point are going to become so unbearable that they're going to have to bite, the bullet and just do it. And the more they postpone it, the worse it's going to be. I mean, the side effects are going to be, much harder to live with. But it is what it is. Steve, Brexit and COVID have created this inflation in UK with sanctions against Russia. Listen, do I believe that Brexit has created inflation? No, I don't. Has it contributed to some small part? Yes, it has. Has it created it? I don't think so. Why I don't think so? Because the UK has very equivalent. Actually, UK has lower inflation than Greece at the moment, right? And Greece has not gone, for example, through Euro exit, right? England has the more or less the same inflation with the US. so on and so forth. Do I believe that the sanctions have contributed to inflation? Yes, I do believe that the sanctions have contributed to inflation. Do I believe they're the main cause of inflation? Absolutely not. How do I know that? Because I've been tracking inflation before we could even envision that Putin would decide to go into Ukraine. Before the sanctions, nobody could even think that Putin would invade the Ukraine, right? So inflation was already multiple times the target, and the rate at which it was moving higher was positive, right? So do I think that these two factors have contributed? Yes. I think they make up a small part of the current UK inflation. Now, we can argue if that's 0.5%, 1%, 2%, worst case scenario. No chance more than that, in my opinion. No chance more than that. So these are not the main problems. The main problems is the policies that had been followed in the past and which, in essence, as I said, peaked with the madness and monetary policy madness and fiscal policy madness and helicopter money thrown at people to remain locked down during COVID, right? That was, in essence, the trigger for the TNT that was gathering up in the set to actually explode, right? It's like the coyote in the Disney series that goes in the set and it's dark and it lights up a match and the set is full of TNT and boom, it explodes. That was the match that lit the set and everything exploded, in essence, right? So yeah, that's what I strongly believe is the case. And as I said, how do I know that the other factors have not been a big contributor? Because we already had super high inflation and was climbing pre sanctions, and having to do with the Brexit. Think about it. Brexit happened several years before inflation started climbing fast, right? As I said, has it contributed a little bit? Yes, it has, right? But in my opinion, these are minor contributions to inflation in comparison, to the main course, right? They're like side dishes. They're not the main course. In any case, today we have more time to talk about, this stuff simply because the markets have really done nothing, right? It's not that I'm stalling into going through the markets. I'm going to talk about a few more markets and how they're positioned ahead of the data that we get, unemployment data from non-farm payroll, specifically from the US. We know that the dollar is going to be super sensitive. Stelio, how do you think the market is going to respond to NFPs today? What would you expect?
Well, I would suggest that a good number would mean that it gives the Fed ammunition to basically keep going. So that's risk off. A bad number is risk on. That's what I would say.
Yes, I agree. What do you think the risks are? Having to do with, do you believe there is a higher chance of a positive or a negative surprise?
That's a good question, because we're expecting a drop from last print. So I don't know, man. I really don't know.
We expect 250, if I'm not mistaken, right?
Down for,
and the previous number was 372.
372, yeah. I don't know.
And we expect unemployment rate to remain at 3.6.
Yeah, as months go by, employment data is going to get worse. But the question is it going to start?
Is this going to be the month?
Yeah, probably not. Probably not.
Yeah. So in any case, a negative surprise is probably going to be a boost, right? A good boost for asset prices, right? For stocks, etc. It's also going to be definitely a hit for the dollar, right? So now, there is another question. What do you think will happen if data comes out as expected. So meaning, what do you think? Do you think we continue the momentum we were seeing during the past few weeks if everything comes out more or less as the market is already pricing in? So do you think the path of least resistance, for example, remains for the S&P to keep moving higher and the dollar probably to slowly depreciate?
I'm not convinced, but I think probably yes. So if
I agree.
Data comes in line, yeah, we just continue to grind.
I agree. Because I
Yeah.
think that if data comes in line, since employment data is currently considered to be good, right? Although I've explained before that if you dig into the numbers, you'll see that things are not so good. A lot of people are taking second and third jobs. And, I've explained before how U3 is really messed up. It really has nothing to do with the way unemployment was counted in the past. So, for example, for every part-time job out there, or for every second or third job out there, that in essence is considered like one more employed person, which is completely ridiculous, right? So people taking extra jobs, which they never do for fun, they do to just make ends meet, right? To put food on the table, to be able to keep paying the rent, to be able to keep paying electricity, so on and so forth, right? So also, average hourly earnings are nowhere near catching up with inflation globally, right? Especially if we consider that reported inflation is a lot lower, a lot higher than
reported is lower.
Report is a lot
yeah.
lower than the actual one, right?
Yeah.
Which shows this is another indication if you're an economist, if you have what is one of the main characteristics of a strong labor market, the ability to negotiate pay, wages, right? When the labor market is really strong, it means that the employee has the power, right? You ask for a raise to your boss. If he tells you no, since the job market is really strong, you're like, you know something, you either give me 10% raise so I can make, I can make back my purchasing power that I'm losing through inflation, or I'm leaving, I'm going elsewhere, I'm going to find a job immediately, because that's how a strong labor market is. So a strong labor market would actually have the ability to stay in touch with inflation, right? Which isn't happening at the moment. Gavin says bullish sentiment seems high once again to me. Yes, that is true. A lot of the bulls, are quite optimistic at the moment. Now, if we want to take it to a technical level, the truth is that we have broken through this descending channel in the S&P. We have broken through the confluence of resistances at 4100 in the S&P, right? So in the short term, we remain well bid, and we might see 4200 being tested. Now, I wouldn't be surprised if we see 4200 being tested or a little bit higher. Then we see a little bit of a pullback back to the channel, and then we have to see and decide what's going to happen from there. Are we actually continuing lower and that's a false break, or are we actually continuing to the upside because we're assuming to the upside? As I said before, right? All this is up to how central banks move from here, because asset prices are currently moving purely based on expectations of what's going to happen, right? The environment of high inflation up to a point is definitely a tailwind for assets, for asset prices, right? Don't forget that some of the companies are complete bubbles and they're worth absolutely nothing in real terms. But many of the companies that are trading publicly have intrinsic value. They own real assets, they own buildings, they own inventory, all that, as anything that is has tangible worth, has intrinsic value, is readjusting to inflation, right? So the nominal price of all these assets is going up, And that is a tailwind and will definitely over time help the price of stocks under such an environment. Of course, as I've said before, if you remove the monetary policy from the equation and you let the markets trade on their own, I was explaining the other day how, in essence, on average, profitability of companies under inflationary environments go down, right? So that, on the other hand, is a headwind, right? But you know how it is. When the market gets bulled up because they believe more quantitative easing is coming, more liquidity is going to be flooding the system, etc., they don't care about any of the real fundamentals, right? Because that has been their main fundamental for the past 15 years, right? Liquidity and money that needs to park somewhere to get some kind of a return, because by manipulating directly and openly bond prices and bond returns, they make, in essence, the comparative return of stocks be a lot more desirable, right? If central banks get out of the equation and they let bond prices reach a real equilibrium, then equity prices are going to dramatically drop, right? Um, that's one of the reasons why they don't want to do that. Okay, let's look at CL, please. If prices head back above 100 later this year, that will be a recessionary and cause high. First of all, we are in a recession, so yeah. So that you know that ship has sailed already, Arif. Now, I do believe that crude oil prices are going to move higher once again. The thing is that I can't tell you when exactly that's going to happen, right? Because for the time being, we are tracking this move lower, right? So I do believe that we haven't seen the high in crude oil, but it might take some time until we reclaim the high, right? So let's take it one step at a time, in my opinion. Now, definitely, crude oil prices moving to the upside again, eventually, which in my opinion they will, is going to be another big hit, A, for economies, B, it's going to be another big boost for the next leg higher in inflation. But as I said, I think the next big leg higher in inflation is probably not coming yet. I think we're getting closer to some kind of a pullback in inflation. I'm not talking about a pullback to 2%, right? I'm talking about just, dropping somewhat from the highs slowly before we see the next leg to the upside in inflation. That's going to happen again due to very, very bad policies that are probably likely to follow, right? So probably crude oil is going to help in that, right? Now, for the time being, I'm tracking the downside. 85 is the next downside target, and we take it from there. In any case, for me to start getting bullish again for crude, I need to see at least a move above 96. So 96 is, an important level for the market to break before I can even start considering the possibility that the corrective move lower is over and done. Politicians never suffer from inflation. Of course, rich people don't suffer from inflation. Politicians don't suffer from inflation. Right. The people that suffer from inflation are lower and middle income families, right? That's the people that suffer from inflation. The problem, though, for politicians is that these are the people that constitute the vast majority of the voting base. So rich people are a fraction, a minority of the voting base. Politicians themselves are even a smaller fraction of the voting base. So everybody else that votes is being affected by inflation, right? And as I've said before, inflation is a very toxic ingredient, politically speaking. And yes, I know recession can be very bad as well. At some point, in desperation, people will always choose to have a job. Sorry. In desperation, people will always have to choose to have a job, even if the money they get from that job is fastly losing its value in comparison to having no job and no income at all. But at some point, the reduction of their purchasing power becomes almost as bad as not having a job. Because once you reach the point that your income cannot really cover your basic needs, you rebel, right? I mean, you're not anymore at all content by the fact that you do have an income, because in some aspect, it's even worse, right? Because imagine you're unemployed, you're sitting at your home, you're stressed about it, obviously, etc. But at least you have all the time in the world for yourself, right? You don't have an income. Yes, that's a huge problem, no question about it. But at least you're not working hard or whatever. Imagine now the alternative. You're working hard, you have a job, you stress over your job, and still you're very stressed because you can't cover your basic needs or your family's needs, or you can't buy stuff for your kid, right? Or you can't send him to the school you want, or you're super stressed because if something happens to you, you don't have the money to address any medical needs that might come up or whatever else. That at some point makes you even more angry, right? Because you are employed, you do what you have to do, and yet the income you receive is not sufficient. And you feel like you're doing everything right, and still you're being penalized. And that brings a lot of anger. Gold and silver, and then I'm going to go through cryptocurrencies. Just a reminder, gold is now very, very near the descending channels trend line resistance. Obviously, as we said before, right? If data comes out bad, right? Dollar should tank, and that might be the trigger for gold to break out. Silver consolidating, this looks more and more like a little symmetrical triangle here than anything else, or a little flag, depends on how you want to draw it. Let's see how this resolves, but it's nicely positioned for dollar weakness, right? Gold and silver, especially silver here, in my opinion, are nicely positioned for dollar weakness, right? Now, alternatively, do you know what I think is rather nicely positioned for dollar strength in the FX world? The Aussie, for example. I think the Aussie is nicely positioned for dollar strength. Right? We've had this big down day. We've had a partial recovery and we've stalled there. So I think the Aussie is nicely positioned for dollar strength. And in my opinion, the data that would bring dollar strength would be what? We've said it already. Good employment data. That would at the same time probably translate to A, dollar strength, B, risk off. Both of them should benefit the downside for the Aussie, right? Because it's a risk on, risk off currency, right? And it's dollar denominated. If we're talking about the Aussie USD. So risk off should push it lower. Dollar strength should obviously push it lower, right? So I think the Aussie is nicely positioned in case data is rather good. And as we said before, both Stelios's and my estimate is that most likely, if data come in line, that is also probably going to perceived somewhat from the market as good data, right? So in my opinion, data coming in line is probably going to be more towards in the direction of, okay, that's good data. So bad for the markets, good for the dollar, because the Fed might remain more resilient in keeping the course, hiking further in the meetings ahead, finally doing some actually reported shrinking of the balance sheet, so on and so forth. Right, but keep in mind, right, and I said it the other day, the balance sheet has not shrunk yet. So there is a lot more downside for the markets if they stay the course, because they've raised rates very little. Because I remind you that the time it took the Fed, for example, to raise rates from 0 to where we are, inflation had already climbed more than that. Right. So if you go back to when the Fed was at 0, inflation was at some point, let's say the Fed was at 0, inflation was at, let's say, 7, 6 at some point, etc. And we were still discussing about it. Now inflation is above 9%, and we are at 2.5%. So the increase in rates has barely just matched lately the increase in inflation. So basically, it has a net effect of practically nothing if it stays where it is. And the balance sheet has barely moved from the all-time highs. I mean, you can't even see it on a chart how little it has moved to the downside. So if they actually want to stay the course, there is a lot more to come having to do with rates, and especially a lot more to come having to do with shrinking the balance sheet, which, as I said the other day, in my opinion, they're probably not going to do. Right? And probably that's what the markets believe as well. That's why they're so frothy and optimistic. Right? Anyhow, let me see if we have any more questions, and then we'll have to go through the data, right, during the F.A.C.E webinar. Lucas says, good morning, Stelios and Steve. Great call yesterday on crude. Thank you. Nice you capitalized. I'm happy you capitalized on that. Okay. Thank you, Arif. Thank you, everybody. Thank you, Stelio.
Thank you, guys. Steve, that was great.
We'll see you all in 1 hour and 45 minutes from now. Bye-bye.
Bye-bye.